Hi, welcome back for the chapter 6. So right now we are trying to dive more into the learning object of determining the cost of goods sold and ending inventory using different inventory costing method. Okay, so the inventory costing method, there's four major methods. There's a specific identification method, there's a first in first out, short for FIFO, right? First in first out. And then there's a last in first out, shortened for LIFO. Okay, and there's a weighted average cost. So I'm gonna explain everything in detail. The specific identification method is matching each unit of inventory with its actual cost. In other words, for example, in a jewelry store, right, or a sports car store, uh, the sales force always can identify each item that is sold to the customer. So hence that the cost of goods sold is very clearly track what product has exactly to be sold, being sold. Okay, so that means that every inventory, no matter it's inside the warehouse or in the hand of the customer, you will clearly know whether it's sold or not. So therefore, the cost of goods sold is clearly traceable. However, not everybody have the luxury being able to trace so many volume. For example, if you go to Walmart, nowadays the electronic system is majorly likely to have the specific identification method. However, not everybody can afford such powerful computer system. So a lot of retail stores are still choosing the inventory method between first in first out or last in first out or weighted average costing. So first in first out, namely, is that the company assumes the first unit purchased are the first ones sold, and last in first out, on the other hand, contrastly, is that assume the last unit purchased are the first ones sold. And the weighted average cost assumes that each unit of inventory has a cost equal to the weighted average unit cost of all inventory items. Okay, so I will give you a specific example that way we can work together on this. Okay, so I will pay more attention into this three system, right? And because later on we're going to talk a little bit more about this one, but this is the pave the foundation for the third video. So if you watch video, I think this video and next video you should pay a lot of attention to. Okay, so let's give you a scenario. This company, Mario's Game Shop, they have a January 1st beginning inventory of 100 units at $7 each. So the beginning balance of the inventory is 700. And then in April 25th, it purchased the 300 units at $9. There's a first batch purchase. And then almost like 6 months later, half year later, and then they went to buy from the supplier again and then for some reason they bought a lot. However, the price goes up as well, so they bought a $600 at $11 per each, and that's why the purchase is $6,600. So the concept that we introduced in the last video is this very important concept called total available for sale. Total available for sale, we said, is beginning inventory plus all the purchase for the period. Hence that totally add up, there's about 1,000 units of product ready for sale, right, waiting people to buy, and the cost is actually adding 700 plus 2,700 plus 6,600 and 10,000. Okay, so this is in the store, the inventory that is ready to be sold. Okay, and then let's see what the sale situation is. On July 17th, there's a sale about 300, and December 15th, there's a sale about 500. So the key here, the most important thing here I wanted you to notice is that this 3, it didn't really tell you what exactly of the 300? Is it a 300 unit from the second purchase, the first purchase on April 24th, or it's the 300 purchase actually from October 19th? That we don't know, right? Or it's actually 300 units from the old inventory from last year. They didn't say. And this is where we as accountant comes in to give a judgment, to apply assumption that this 300 maybe come from here, maybe come from here. That's why we call it, based on different assumption, we come up with different method. Okay, and then that's next thing I want to show you. As long as I just want to stress that this 300 and 500 is actually a real product outflow, but we did not know exactly which layer of the cost, we call it a cost layer, it's coming from. It's coming from the old layer or newer layer, okay? But we do know that based on the cost, the units, there was 1,000 available and they're sold 800, hence there's a 200 left, right? So that we know. So 1,000 minus 800 is 200. So regarding the cost, that's where the place. Okay, so please remember there was a $7, $9, and $11 cost layers, and $7 has 100 units available, $9 has a 300 units available, and $11 have a 600 unit available. Hence, in order to assign this $800, 800 units, the cost of this 800 units, we have following method. First one, we use the FIFO method. FIFO method, namely first in, first out. Okay, so tell me, out of this 3 layer of cost, the most earliest in should be the ones in the January, right? So these are the ones that are oldest the most, and this is second oldest, and this is third oldest. So therefore, if I say first in, first out, so the first one gets sold should be the oldest layer, which should be those 100 units at $7 should be out. And then because I trying to sell what 800 units here, right? So that means this 100, after I used this 100 to give to a customer, the next thing I needed to taking out is this 300 units at $9, right? And then the last one to fulfill the order of 800 is the 400 coming from the latest order, which is $11 each. So therefore, the total cost of my cost of goods sold should be 100 multiple 7, 300 multiple 9, and 400 multiple 11. Hence, the sold of the first 800 units should be $7,800. And my ending inventory obviously is gonna be 200 units at $11, which is the latest purchase, and then it's equals 2,200. So as last video we said, we split the cost of goods sold available for sale into the cost of goods sold pool and the ending inventory pool, and then based on the FIFO method. Okay, so you kind of a little bit understanding what is FIFO now. So let's see what is the LIFO. Maybe you help you more clear about what's going on. So using FIFO, exactly, we needed to sell 800, right? So LIFO is last in, first out. So the last purchase was $600. 800 was at $11 a piece, right? And we bought 800 total. So what happened is that we bought 600 units. Let's go see the purchase. See, the last purchase is actually $600 in total at 11 each. So therefore, last in, first out should taking this layer first, and then sum of this layer second, right? Hence that we are gonna take out the latest purchase, which is $600 at $11 first, and then we take 200 units out of the second purchase. This is the first, second, and third. So we start with the third time purchase the latest purchase first. And then once we fill the order of 800, we stop, right? So therefore, the cost of goods sold should including every unit of the last purchase at $11 and result in 6,600, and 200 units from the second purchase at $9 a piece and result in 1,800. And the ending inventory should be whatever left in earlier, right? This is early layer is what left. So that would be 100 units at $9 and 100 units at $7. So in another word, it's like a tube, right? So you put this is the first layer, this is second layer, and this is third layer. So last in first out, start eating from third layer first, and then eating a little bit of second layer, because third layer is at $11 and the second layer is at $9 and the first layer is at $7. So last in first out, starting eating the latest, which is on the top of the jar, right? So you eat this section and you leave what is old still inside the tube. However, like more visually, is if this is the inventory tube, there's a first layer here, second layer here, and third layer here. And the first layer is gonna be the beginning inventory at $7 a piece, and the second layer is gonna be the first purchase April 23rd at $9 each, and last layer is gonna be $11 a piece, right? So first in, first out, we're taking from the bottom first layer, second layer, and the third layer, because the quantity of the third layer, this is 800 units filled the order, right? So we're starting with the bottom and leave the upper level, leave the earliest purchase left as ending inventory. And then for this one, the earlier purchase here become the ending inventory. Okay, so therefore the last in first out, we're eating from the top layer, which is the latest purchase, and then we're left with older layers, old cost layer. Okay. So many students find it surprising that a company are allowed to report inventory costs using assumed amount rather than the actual amounts. The reason is because there's a lot of costs involved into estimation the inventory cost. However, nearly all companies sell their actual inventory in a FIFO method. So a lot of people cannot afford a computer system to trace. Even you cannot trace that well, okay? But they are allowed to also report the inventory cost of goods sold as if they are sold in a LIFO manner. And we want to tell you why there's a choice, what the benefit of FIFO and what is benefit of LIFO, and why normally people, what motivated people choose FIFO, what motivated people choose LIFO. Okay, so let's do a quick question. A company has the following inventory transactions. At the beginning of the inventory, there's $100 at $4 each, right? And January 15 is a first time purchase, and it's 100 units at $5 each. And January 31st is the second time purchase at 100 units at $6 each. What would be the cost of goods sold under the FIFO method if 120 units were sold in January? Okay, so therefore, if we are using FIFO, that means that we have 3 layers, right? I want to draw it. I find that this very helpful. So the first layer, the 100, is actually $4, right? Because it's beginning. And second layer is at $5 and the 100 units. And third layer is the 100 units at $6. So right now, since we're using FIFO method, so that means the first in, which is the oldest layer, first in, first out. So therefore, we're gonna start with in 100, we sold out this one, multiple $4, plus we need 120 units. The 20 extra units will be fueled by the layer, cost layer of $5 each, right? So therefore, we're gonna have a 400 plus 100, we're gonna have a $600 of cost of goods sold. So I will choose A. Oh, sorry, I'll choose B. Yes, I will choose B because 20 at $5. Oh, sorry. Yes, this is a 500. I will choose B, 500. Right. So 400 plus 100 is 500. Okay. I record this too late. Okay. See, that's what happened. So next time, let's do the LIFO method. Same thing. I will draw a bin. Same thing, right? At the first layer, second layer. The first layer is at $4 each at 100 units. Second layer is $5 each at 100 units. Third wheel is $6 and 100 each. So right now we use the LIFO method. LIFO method. So last in first out. That means we started taking out the inventory from cost layer of $6. With 100%, we take this one out, and then the extra 20 we're taking out from $5 each. So 100 multiple 6, right? This layer, and a 20 multiple 5, and we add up together is 600 plus 100 is gonna be 700. So it should be D if you use a LIFO method. Okay. So hopefully this gets a big idea of LIFO and FIFO. It's just like where do you take first. If it's a FIFO, you were starting with the bottom drawer, right? And eat it until that you fulfill your order. If it's LIFO, you will start with the top drawer, which is the latest purchase, to take out the inventory, and you will end up a totally different cost of goods sold number. Right. Last one we said is this is actually FIFO method of cost goods sold, and this is actually LIFO method of cost goods sold. It's a big difference of $200. Okay. So now the third method we are talking about is called weighted average of cost. Under this method, we wanted to do blend in. We wanted to do a little bit average kind of thing. So both cost of goods sold and ending inventory consists of a random mix of all the products available for sale together. Hence that each unit of inventory has a cost equal to the weighted average unit cost of all inventory. In other words, we're creating a unit price based on all inventory available for sale. Right, so we shake this jar. Before we still can see, oh, this is the first layer, second layer, third layer. Now we're shaking them up. We get a one number, one unit price, and then use this price to differentiate ending inventory and the cost of goods sold. Okay, so and then quickly so the weighted average cost is calculated as cost of goods available for sale, the total cost divided number of units available for sale. Okay, let's say same example, 100, 300, 600 at 7, at 9, at 11. So the cost available for sale is 10,000 here, and we have a 1,000 units. Naturally, weighted average should be 10,000 divided in 1,000 is $10 per piece. So therefore, cost of goods sold, if you tell me you sold 800, then I will multiply 10. I get 8,000 for cost of goods sold. And then you tell me the ending inventory is 200 units not sold yet, so I will multiply this weighted average unit price. I get ending inventory for 2,000. Okay, So we wanted to talk a little bit about what's the difference between weighted average and simple average. Weighted average here, the weight is actually, we need to consider the unit costs instead of the simple average. So basically, we wanted to use 100 multiple 7 and 300 multiple 9 and 600 multiple 12. We wanted to add all this together. This unit is actually the weight. How loud the voice of the $7 piece in terms of 10,000. So right now, if we add this whole thing together, is a 10,000 piece, right? So 100 units at $7. This price is a very weak, right, voice in terms of to determine how much this 10,000 units at what price. But the 300 is relatively okay, but the 600 at the $12 each is very loud voice because it's contain about 60% about this, right, about this whole jar. So in another word, in the example from previous, in another word, the weighted average, you need adding the unit multiple price, multiple price, and unit each layer of the total cost together. Instead of using a simple average of the cost only, instead of just adding 7, 9, and 12 and 11 together and dividing 3, okay? The simple average, though, fails to take into account that more units were purchased at $11. Like I said, where 600 has more voice in this 10,000 rather than 100, right? Than 7 and 9. So we needed to weight the unit cost by the number of units purchased. We do that by taking the total cost of goods available for sale, which is $10,000, to dividing the total number of units for sale for 1,000. We get an average of $10 a piece. Okay, so now we want to do a comparison about what's difference. Although I want you to keep eye on each number, so now we put it together, make it more clear. So inventory at the beginning of year is 100 at $7 piece is 700, and the first purchase during year is 300 units at $9, which is 2,700. Second purchase during the year is 600 units at 11 for piece is 6,600. So this is a whole goods available for sale situation, right? This is a whole goods available for sale situation. And we also know that there's 800 pieces actually sold. For LIFO method, we started with the top layer, so that means that we take 100 out, we sell every unit of the 100, $7, and we sell every piece of this first purchase, and we sell about 400 out of the second purchase, right? We're taking the inventory from the earlier to later, and then the leftover, the ending inventory, is actually coming from the latest purchase, which is 200 at $11 each. If we use a LIFO method, we're starting with the latest purchase, which is second purchase during latest. Late means that recent, most recent purchase. Hence, the second purchase is more recent towards now, right? So therefore, we take 600 from the $11 each, and another 200 from 300 each, right? Once we exhausting this cost layer, we move on to the earlier ones. And then the leftover cost layer is going to be the beginning balances of the old inventory from previous period, right? 100 multiple 7, and the leftover 100 in this 300 $9 cost layer. Okay, and it result in cost of goods sold for 8,400. So I wanted you to notice these two numbers. So 7,800 is the inventory cost of goods sold we're getting from what, FIFO method, and then 8,400 is the even cost of goods sold we're getting from LIFO. Let's look at weighted average. Weighted average, we said the unit price is actually 10, right? And 10,000, you see $10,000 available for sale, dividing 1,000 units is $10. So we sold 800 of them, so therefore 8,000 is cost of goods sold, and the leftover 200 units will be assigned at $10 for piece. So therefore our ending inventory is 2,000. So weighted average is the cost of goods sold is 8,000. Remember the number. FIFO, we have cost of goods sold of 7,800. LIFO, we have cost of goods sold of 8,400, and weighted average, we have a cost of goods sold of 8,000. Okay. Companies are allowed to report. So therefore, as we can see, the FIFO actually have a lowest cost of goods sold. LIFO have a highest cost of goods sold, and the weighted average is just in the middle ground of these two methods. Key point we want to take away is that companies are allowed to report inventory cost by assuming which specific units of inventory are sold and not sold, even if this does not actually match the actual flow. So therefore, like your cost assumption say, oh, actually in my book, I consider the latest inventory sold first, but in fact that the oldest purchase should be the one sold first, right? So in accounting, you say, oh, you tell accountant, say, hey, you didn't really trace what is the actual flow of the inventory. Was that okay? It's allowed. GAAP allows it, okay? And the three major inventory cost flow assumption are FIFO, LIFO, and the weighted average. Okay, so now we want to tell you why we're allowing it and how which method is actually benefits for balance sheet way, and which method is actually more beneficial for inventory. So for income statement, we want to explain to you the tax effect and the financial statement effect of each inventory cost method. So after we introduce FIFO, we want to summarize FIFO as the following characteristics. FIFO method matches with the physical flow of most company. For example, if you are a grocery shop, of course you want to sell the product that you purchased earlier than later, right? So otherwise you will experience spoilage, right? Because your inventory will be if it's already old cart of milk, you want to sell as fast as you can. You don't want to always sell the most recent purchase, right? So that's actually in universally is true, because a majority of the company matches the physical cost of flow using FIFO method is the most matched, because the FIFO method assume that the first thing comes into the door, the first things are sold out, right? And also the second characteristic is that the ending inventory of the FIFO method also reflecting the current cost exactly. So when you purchase things most recently, is most in the FIFO method is the things that you left in your inventory list, and your inventory list is gonna be most the current cost that you recorded, right? Hence that we call this method a balance sheet approach, because on the balance sheet you reflecting very well about what is the true value of your inventory, because the inventory left in the warehouse in the GL account is actually most recent purchase. That's more close to the reality, right? And the LIFO method in nutshell is that the cost of goods sold reflect the current cost. Exactly, because you are trying to sell the latest purchase as the first, hence that the cost of goods sold account reflect most current cost of the product. And hence that we call it the income statement approach. And the LIFO conformity rule means that companies that use LIFO for tax purpose must also use LIFO for financial reporting. Why is that? The reason is that if you use a FIFO, you will end up with a lower cost of goods sold. So FIFO is actually associated with FIFO cost of goods sold is lower, right? And the ending inventory is higher. And the LIFO method cost of goods sold is actually high because you sell things more expensive first, and the ending inventory is actually lower. So therefore, for tax purpose, you will choose LIFO for tax, because if you have a very low cost, higher cost of goods sold, your net income gonna be lower. So your reported net income is gonna be lower. Hence, that you can save a lot of tax. However, on the FIFO method, because your expense, which is cost of goods sold, is lower, so your net income is going to be high. Hence, that you cannot save tax. However, you have a higher performance, higher profitability, right? So therefore, if people more care about the tax, they will more likely to choose LIFO. If people care about the profitability, they will choose the FIFO. But there's a LIFO conformity rule saying that company that use LIFO for tax purpose reporting must also use LIFO for financial reporting, meaning that you cannot use the FIFO for your financial reporting purpose and use LIFO for your tax purpose. That way you taste the sweet on both sides. So tax authority, IRS, said if you choose take advantage of FIFO for tax preparation purpose, then you also have to make sure your financial reporting is also choose FIFO method as well. We will talk about this in detail. So the balance sheet, the ending inventory for FIFO method from last example is 2,200. The LIFO method for the ending inventory is 1,600, and the weighted average is $2,000. And the income statement, which is related to the cost of goods sold method, is that your sales revenue, regardless what the method you choose, is gonna sell at $800 and $15 for piece. It's all gonna be 12,000. But cost of goods sold for FIFO method is only 7,800. LIFO method is 8,400, and weighted average is 8,000. Hence, that your gross profit for FIFO is the highest one, right? And your gross profit for LIFO is the lowest one, and the weighted average is in the middle. So therefore, the choice of inventory method or inventory assumption, whether you use LIFO or FIFO, has related to how much you're reporting in your ending inventory and how much you report as a cost of goods sold, and further influence your net income. Okay. Right, so as we can see, FIFO method are associated with the highest net income or gross profit, and LIFO method is likely to associate with the lowest net income. And the FIFO method are left those most expensive recent purchase in the ending inventory, and the LIFO are left in with the earliest purchase, which is cheapest purchase in the ending inventory. So if you choose to use a FIFO method, you have also to show the LIFO differences on reported in inventory balance sheet. So for example, you see FIFO inventory means that the most latest purchase is left in the inventory account. Hence, that's very high, right? 7,850. And then you also need to tell shareholder, saying that, okay, if I was choosing LIFO method, how much should it be? So it actually should be so if you say your LIFO method, actually total cost should be 6,561, but you also need to tell shareholder that you need to reduce 1,291 out from the FIFO inventory ending inventory to reflecting the FIFO method. Okay. Okay, so generally FIFO are more closely resembling the actual physical flow of the inventory when the inventory costs are rising, right? And FIFO result in a higher reported inventory in the balance sheet and a higher reported income in the income statement, as we see here, right? Higher, 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 lower, lower, okay? And the FIFO result, conversely, LIFO result in a lower reported inventory and net income, reducing companies' income tax obligation. Okay, let's do a concept check. During period of rising purchases, oh, and this this generally happen when there is a big assumption of the condition of this conclusion will be drawn is the most latest purchase is actually more expensive. So this sentence is very important. When the inventory costs are rising, what this means that the latest purchases are more expensive, or earlier purchases are cheap. There you can get a conclusion that the FIFO actually result in higher reported income and the higher reported inventory. Okay, but if you say LIFO, only this holds, only the costs are rising, that can draw this conclusion. So let's look at this example. During a period of rising prices, okay, this is very important. That means that the later purchase are more expensive, right? So which inventory cost of flow assumption would result in highest cost of goods sold? Highest number of cost of goods sold, and therefore lowest of income. Yeah, so if we want the highest good of cost of goods sold, we should choose the cost layer that most recent purchase, right? Because the price, the period, the price is rising. So we should choose LIFO because latest in, first out. So the latest purchase is the one calculating cost of goods sold, and the latest in is expensive. It's expensive, highest cost because the cost of the products is rising, right? Okay, so using LIFO, we assume that the last unit purchased, which is the last one in, are the first one sold, first out. If the prices are rising, cost of goods sold would be composed the latest cost using LIFO. Okay, which inventory method or cost flow assumption most closely resembling the actual flow? We talk about it. It's a FIFO method, right? Like a grocery store. Grocery store is not gonna sell you today. So if you have say carrots or milk inside of the refrigerator, the milk loading staff definitely push the earlier purchase in the front. That way you can get it, and the later purchase in the back you cannot reach, because if they don't sell the earliest purchase to you, the milk is gonna expire soon, right? Okay, so we're gonna move on to the recording inventory transactions. So I decided this chapter into 4 videos, hence that I will see you in the next video. Okay.